For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
We had that special situation where it happened all at the same time, which is to say a situation where we can combine our charting, our technical analysis, our view of the market with applied volatility analysis. Now, most everybody here is, they understand TA. They're probably better at TA than I think. They have probably challenges and obstacles with pulling the trigger or expressing their technical analysis view. And I'm certainly not generalizing. And remember, I'm always coming from the point of view that I've been in everybody's seat on the other side. I've stepped in all the potholes, and at one time, long time ago, John did as well. And we're always students of the game. So I speak from experience. It's easy to see something in the charts, be fairly convicted, and then chicken out and lean on the rules of our trade. And I'm going to show you how you can start to evolve beyond that. And many times when you can get a confirmation, or at least the two types of major analyses that we do, which is technical analysis or charting and applied volatility analysis, come together, you have a very high probability trade, which is exactly what John was talking about in the beginning, which is the essence of what we're trying to do. So let's walk through that. I wanted to give you the market context of where these two things came together. From a charting perspective, now we're on May, and I'll get to the charts, but I just want to lay down the foundation. May 24th of this year, we're looking at the Russell. There's what we called a 2-bar or 2B reversal, which is effectively a fake breakout of a range, triggered on this day. And there was also a price pattern target hit. And for those of you who watch John's market outlooks, you know he's uses those quite frequently, and they are, to this day, still amaze me in their accuracy. So you have two very strong, and on this information alone, you could take action, right? You don't really need more than this, but let's fill out the rest of this picture. I had on a M34U, your basic M34U, there was 24 days left in the trade. I did notice in my trade, mostly from experience, but also from the modeling in the O&E software, that my delta was a lot more positive than it should have been relative to where the market was in the 10. And I'll show you all this. Again, I want to set the stage. And the position was quite drawn down. And there wasn't a material move in the market. You know, if the market had really zoomed outside the tent to the upside, or really fell out the backside of the tent, we would expect a pretty good drawdown in the trade. But this market hadn't really moved that much, and so I'm noticing some activity in the position that is not meeting my expectations. And some of that's based on experience, but I'm also going to show you how you can read that in your T+0 line. And effectively, when I'm seeing that in my...
It's so important, Stephen, to have expectations, even if you
Yes.
are wrong with those expectations, is so you understand whether things are going the way they should be, and if they're not, maybe taking some clues out of that.
Yes, and it's, yeah, and expectations, to your point, not only in our charting and our technical analysis, but expectations in how the positions should be behaving. And let me put some context around that. Should it be drawn down? Should the position be up or down? And we're talking about material, you know, on a 10 lot. I'm not talking about, you know, $50 or something. If it's up or down $500 and the market hasn't moved, that's information. If the delta is much more positive delta or negative delta than it should be, that's information. And of course, everybody's like, well, wait, I don't know what should be is. I get it. I hear you. Some of that comes from experience. And again, I'm going to show you how you can read that in your T+0 line and get a sense of, effectively, this last bullet point, the market participants in this situation, they were flattening the skew curve, right? they were expecting something. I mean, I could see it in my T+0 line. And so that typically, in this scenario, typically suggests a down move. So you marry those two things together, and I've got my IV analysis is confirming my TA setup. I mean, we're talking 90 plus probabilities. I mean, these are the kind of things that you have to hit these kind of trades. And we could talk about how, and at the end, I'm going to touch on ways we can express that. But it's not, this doesn't always marry up, John. I'd be curious, what would you say, how often does it? I mean, we do rely a ton on our TA because we get immediate feedback. IV analysis sometimes can be a bit more subtle, but like you said, when we have expectations of how the position should be behaving, and when that deviates, we marry that up with TA, man, that is edge on top of edge.
Yeah, I
right?
mean, yeah, your trading is all about discovering trading edge. And, if you're just blindly throwing on rules without any context as to what's going on in the market or through implied volatility, you're at a pretty severe disadvantage. And you can, if you're understanding, is the charting lining up, is the implied volatility lining up, and you can take some sort of a meaning from that. We talk about how many traders see this. So you see the chart. If you understand charting in different time frames, you can see, hey, this is a level, maybe a resistance level that our long-term traders are seeing, our short-term traders are seeing, and our implied volatility traders are also confirming that because they're doing certain thing with the implied volatility skew curves that we can see.
Right.
That sets you up. I mean, that puts probability on top of probability. And if you're in a standard rule-based trade, and you're completely oblivious to what's going on under the picture, you might be trying to flatten your position to zero delta at a time when you do not want to be zero delta because everything in the world's telling you the market's going down, right? So,
or worse, you're adjusting the opposite direction. Which
right. You're
happens.
adjusting up, yeah.
Yeah, and it's the difference between flying blind and flying with the wind at your back. Right. And so, and by the way, for those for our existing members that were in the pro room, I brought this up or touched on this in real time, or maybe it was the day after, I can't remember, in the room. And so this was a suggestion from one of the members. And we did have another member, by the way, who was astute enough to see this same change in their position, actually a couple days before the TA setup. So kudos to that individual. I can't remember their name, but shout out to them. So for those of you who are, said, hey, let's go over this in a pro meeting, here it is.
There you go.
So let's get to the technicals on this. So let's always keep everything as simple as we can, right? So this is the Russell. This right here is May 24th, and this is the trigger day. Coming into that, Russell's just in a range, right? I know this may be a little messy with some moving averages, but keeping it really simple, we are in a range. The market's not going anywhere, okay? On this day, the market is attempting to break out and breaking out aggressively, at the open. You got to remember when you look at these candles in real time, that is a green, big, long candle. And when you look at this at 9:30 in the morning or 10:30 in the morning, that looks very bullish, right? So this is the end of the day. So you have to kind of remember and visualize what these candles look like. This is a daily candle, but what it would look like intraday. So you're thinking, wow, here we go. This thing's breaking out. And of course, the index and the SPX at this stage have already been moving up, making higher highs and higher lows since the beginning of the year, and the Russell's been lagging. So one can start to conclude in the morning, hey, the Russell's catching up. But once you look at this a little further, you say, well, wait a minute. We do have a price pattern target, which was nailed almost to the number. And when you hop down to the lower time frames, hourly, 30-minute, whatever, we start to close below that. By the way, that was literally the highest point of this range. we start to move back below that into range, my antenna goes up. And this is the 2-bar reversal or 2B reversal that
Right,
we've
on a
talked
shorter
about
term
in the
time
past.
frame.
On a shorter term time frame, right? You wait for
Right.
this on a daily, you've missed the trade, right? So markets are fractal. So if I go down to a 30-minute, 10-minute, even an hourly, I believe it was on an hourly, it might have been on a 30-minute. This closes back below this 1810 level. That's confirmed on that time frame, right? Now you can certainly wait to the end of the day, but you can see you've kind of given up quite a few points before you express some kind of a bearish trade. So that's another thing to keep in mind. Now, you say, well, yeah, man, that happens all really fast, but not really. Let me tell you what the edge was on this. This price pattern target. When we hit a price pattern target, oh, by the way, this is the 200 moving average, 200-day moving average. When we hit that, I'm expecting the market to pull back, regardless of posture. Now, had this closed above this with some aggression, maybe even some volume behind it, then yeah, it's a full-on breakout. But when you start just piecing together the preponderance of evidence, right? We hit a price pattern target. We were backing off on the shorter time frames. We started to break out in the morning, and now we're making 30-minute and hourly closes below that level. I'm thinking bearish. And so that's the context that you're seeing right there.
Right. So you have an expectation. You want to monitor that expectation, right? So
Yeah.
Steven sees the breakout, which isn't too big of a surprise, right? Because we get intraday breakouts all the time. He sees it, but then you want to monitor it. So it comes up and it starts to pull back. Okay, well that's normal. If it's bullish, it should pull back above support level and then continue higher and break into a new swing high. In which case you want to maybe adjust to the upside intraday, right? But here you want to watch it. How's this behaving above this level? Oh, wait a minute, I crashed back down under my level here. Oh, wait a minute, that's very bearish. I'm going to hold off and wait and see what happens before I make my adjustment. Or if we want to take the bearish trade or whatever, right? But, yeah. It's all on how it reacts.
Exactly. Now this is going down to a lower time frame, so let's go to the hourly. So this is the morning. We get the first hour, so you get the first two periods, and you close above it. This being let's call it 1810 is the highest point of the range. So this is breakout. We tag the price pattern target, and then we immediately reverse back below. This should have, to John's point that he just made, should have come back and test this level and bounce out. So when we close back below this, and we've hit this price pattern target, and now we're making another close below, the reversal is on. Or at least the high odds of the reversal is on. There's no certainties.
Right. For those of you who follow candlesticks, that's a very bearish candlestick pattern at a resistance point. So it's once it's confirmed with a breakdown under it, it should go. It should go. Yeah.
Right. So just again back to that concept of expectations. This should have come back to test the breakout point and then bounced, or at least gone sideways and stayed above it and showed some acceptance. When it started closing back below, that was your sign. This is a fake breakout, aka 2-bar reversal.